the Valley Current.
Hey, Steve. Okay, great. So, Steve, you're in the thick of tax season right now. What does it feel like? Must be time for you.
It's slightly overwhelming. We do what's on the top of our queue and try and do it well, and then we do the advance to the next item.
Well, people make the April 15 deadline through you, right? That's in a couple of weeks.
It is. Many people think that filing on April 15th will reduce their likelihood of being audited, but actually that's reversed.
It's better to get an extension, isn't it?
The people who file in October are the ones who are least likely to be selected for audit. And I imagine that is enhanced by the recent reductions in IRS staff.
That's what I heard. I heard the reductions in the IRS staff have people sort of taking more aggressive positions. I don't know if you want to weigh in on that one.
I think that the weight of consequences on taking aggressive positions has been reduced by the actual or rumored layoffs. The judiciary seems to be reversing some of these layoffs. Perhaps you want to weigh in.
Well, I think we have a battle going on between the administration and the judiciary, with Justice Roberts making what was a sort of a funny milquetoasty kind of statement. It's not appropriate for Trump to be talking about impeachment of a tenured federal judge just because he disagrees with the judge's rulings. That's why we have appellate courts. I mean, that's a very light statement to be made by the Chief Justice. I think other Chief Justices might have made a much more pointed statement to him. And Trump has a number of cases that are pending before the Supreme Court. So his lawyers must be saying to him, man, you're making our job a lot harder. That's for sure. There's just no question about that. Judges are human. It's hard for me to believe that he gets a totally neutral audience in front of those 9 justices, but we'll see. I mean, we'll see what happens.
That much experience, but when I was in litigation, the lawyers made me wear a muzzle.
Right. You have to be very careful. I mean, even the body language can do the wrong thing. But let's talk about what happens when people get scammed, because it seems to me that the IRS maybe is becoming a little more lenient on letting people take a deduction for scam situations. And as you know, because you referred the client who will remain nameless, we often see, and we did have seen, clients that sometimes end up in 7, which is like the entire life savings that sometimes people have in their 70s or 80s, being scammed from them, which is hard to believe that kind of stuff can happen, but it does happen. And I don't know what happens when that happens. Does that become a deduction on future income? I mean, what actually happens when a scam is successful and someone loses any amount of money?
Hopefully, the victim goes to you or me, and we might both get involved in different aspects. Before TCJA, there was a loss casualty deduction. But then in the spirit of kick them while they're down, the TCJA's 2018 tax revision decided to take away that deduction. And it's no longer available as an itemized deduction. So now you
get zero for the lost money that was essentially stolen from you on false pretenses?
And now it depends. Your best situation is if there was a business involved, and this has aspects of a business loss. The personal loss went away, but business casualty expenses are still available.
So if the person operates some type of, let's call it, trading business where they're trading stocks or options, as part of their retirement account. They do enough trading, I suppose, to be able to call it a trade or a business or a profession. They have an LLC and they get scammed and they lose, say, a couple $1 million or even, less than that, any amount. Can that business, the LLC, even if it's a single member LLC, take that deduction because it's more of a business?
If there is a business with an intent, business intent, then yes. And I've got to caution you, though, that some things that intuitively feel like businesses, like a personal investment activity, are actually personal activities, not business activities. And it's almost impossible without something like a 475F election to have an investment activity be considered a business.
So what's
even
a,
if it's inside a corporation or an LLC?
What's a 475 election? What's that?
So a 475F is for an investment activity that has risen to the level of day trading.
Okay, so that's where you're getting some sort of 60% capital gains treatment on all the trades because there's a high enough volume and it's a significant amount of time, that sort of thing.
And as a mark-to-market, 475F is also called a mark-to-market trading activity. And once you reach that volume and frequency of trading, then the capital gain or loss becomes an ordinary gain or loss. Business expenses become deductible, and the wash sale rule goes away, all of which can be highly beneficial to clients.
So, there's a lot of people that in retirement try to basically deal with their boredom by looking at the stock market. That's the way I think of it. Different people do different things. My dad used to go to Las Vegas and play $2 blackjack, which drove my mother crazy. And she just hated the fact that he was gambling. He said, "That's my Social Security check. I can do whatever I want with it." And
calling it a hobby is not helpful.
Right. But
it does require a frequency of activity. So he would need to be gambling to qualify for 475F. He would need to be gambling perhaps 80 or 90% of the 200 business days in the year.
Okay, so you're saying realistically, you could be a gambler and you could treat it as a trader profession if the volume of activities is really significant, right?
If the volume of short-term trading activities is not significant. Long-term trades do not count for this purpose.
And that's true in the stock and option field as well, right?
Options do not qualify for 475, only stocks.
Is that right?
For 475, that's correct.
Really? So if the scam happens to the investment account and it's a personal investment account and there's no 475F election and it really couldn't qualify for 475F, then it's a personal loss. The scam is a personal loss. And you get no value out of the fact that you lost a significant amount of money to someone who maybe broke into your account or impersonated your password or did something that generated a wire transfer, which is often what happens now. Getting a wire transfer done these days is like going through hell. The banks double, triple check it. They cross-examine you. They ask you a bunch of questions. They want to know if you verified the phone number. It just seems like a very hellacious process. But I guess they have to do it because they're worried about liability. The banks are, right?
Yeah, they're worried about attorneys like you.
Well, they're worried that attorneys are going to say, well, didn't you think something was wrong here? That sort of thing. And, you have to wonder because there must be some cases where there are, I guess, I'm not saying I've met any of these people, but there are people that would pretend to be scammed to kind of get the money off of their estate tax return if they have a significant amount of money and they're worried that the exemption, which is still pretty relatively high for most Americans, is insufficient. And they say they've been scammed, and they basically move the money to some offshore jurisdiction that's kind of hidden forever. And they just claim, oh, some scammer took all the money. I mean, they're kind of like scamming the government in that case by claiming to have been scammed, right?
And if elder abuse can be claimed, then they can even recover attorney fees, can they not?
Right, but I'm saying if they're involved in the scam, because they're trying to move the money out of their estate to take the view that they're, I don't know what the right word is. I'm going to say homeless, but it's not really homeless. It's like people who are wealthy and end up on Medicaid because they set up all these trusts and they move stuff out, and they call them Medicaid millionaires. But imagine that they're using this scam idea to say, oh, I was scammed. I lost millions of dollars to a scammer. I don't know where the money went. And it's in some hidden bearer bonds in Switzerland somewhere or something like that, right? That's possible, right?
It is possible. They've been closing down on that overseas stuff. They're now with the FBARs, the FinCEN 114 and similar reporting. And they had a BOI reporting until Treasury decided they were not going to enforce it. But I think overseas is somewhat limited because of cooperation between the countries. But that I assume that, I try and avoid clients that are skirting the edges of legality. I don't want to be involved in such activities or even be accused or contemplated that I might be involved in such activities myself. So I would not take a client who had indications of.
Right. Neither one of us would. But just generally speaking, there are people who use the scamming concept, I'm sure. I mean, even today, I think there are people that accuse, maybe without proof, maybe with some proof, that SBF, Sam Bankman-Fried, claimed that the company lost like $400 million. Like, oh, don't worry, it'll be found sooner or later. Like, it's somewhere. I mean, it's throughout all these books that are written about him. And who knows? I mean, maybe he was like stashing that money away somewhere for a rainy day. And of course, the rainy day happened and he wasn't able to get access to any funds because he was in jail without any computer and without any cell phone, kind of stripped of all of his electronics. And who knows? Someday he may get out of jail. He'll probably be in his 50s or 60s. He's got a 25-year sentence, I think, or maybe 20. And maybe by the time, if he's a good prisoner, maybe he'll get out in 15 years. And maybe he'll somehow come and find that money hidden somewhere. I mean, who knows? He obviously is very familiar with cryptocurrency. So who knows where that is? It could be in a Bitcoin account somewhere in a cold wallet that only certain people know about. I mean, I'm not accusing him. I'm just saying there have been people who have said there was a lot of money that was lost to the accounting within the FTX system. And it happened pretty close to the time that the cards all caved in. The house all, the cards all collapsed in the sort of house of cards. So who knows? Maybe he's.
It reminds me of a situation in Southern California where somebody had lost a huge amount, I want to say in the neighborhood of $1 billion of cryptocurrency in a hard drive that went to the landfill.
Right.
Compel the landfill owner to dig for the hard drive.
Yeah, so that was another one that I wanted to ask you about, which is, so let's say the guy admits in the course of being interviewed, yeah, I bought, let's just say bought $1 million worth of BTC, Bitcoin, and it went up tenfold because it went up way more than tenfold. But let's just pretend it went up tenfold. It was worth 10 million. And there was 9 million of gain there. Does the IRS say, oh, you can't find your wallet, so you have no gain, so there can't be any sort of realization of the gain, so I guess you get away with not paying those taxes because it's all sort of intangible gain located in some account that is more or less unavailable to him? Is that the way that's treated?
Yes. So as a cash basis taxpayer, potentially, yes, there's two rules on deferred revenue, one of which is called constructive receipt. So if the person really had access to the cryptocurrency but was lying about it, then it's possible that they have a gain. On the other hand, investments are typically, and Bitcoin is treated as any other type of investment, such as stock. It's considered realized when it's traded. And since he might never be trading it, he could potentially delay realization and recognition indefinitely.
Right, but it could be, like, if we want to play devil's advocate, it could be that this guy created this big ruse to say, yeah, I lost it, it's gone, never be found again. And he leads everyone to believe, what an idiot. That's just awful. There's a German word, and Schadenfreude, or there's some German word like to take great relish in someone else's disaster scenarios. I can tell you a story about that, but basically just leaving that to one side. Conceptually, he might have done it just as a way to lead the government to believe, you can't tax me on this because it's gone. It's sad, but it's all gone. And in the meantime, he kind of moves to Switzerland, changes his identity, maybe changes his passport, does a bunch of stuff. And all of a sudden, he's got $10 million of crypto somewhere in the hands of somebody else, maybe a proxy or a trustee or something. And he's living the life of Riley, having scammed the government out of their tax on the $9 million worth of gain, right?
Well, if he is lying about it, then yes, that's potentially fraud. But I could see that conduct being completely legal from a tax standpoint if he were to be honest that, yes, I still have access to this crypto and I'm going to I'm going to borrow against the money if I can find a bank to lend against it. And then when I die, it steps up in basis.
Oh, you're saying if you got the right tax advice from someone like you or another tax professional and say, you don't have to lie about it, just, play your cards correctly, right?
Just step up in basis. When you pass away, the bank gets repaid, and right. You got to enjoy spending the money.
There must be some weird situations where people who get no tax advice at all see some parent who is otherwise kind of on their deathbed, and they think to themselves, oh, we better get dad to sign the deed over to us so we can sell the property really quickly. And the father is still alive and there's accumulated depreciation and the basis is down to near zero. And they think this is great. We're going to basically get away with murder here and taking the title from before he dies because we don't want to rely on whatever his will says. And they must get the real lecture from somebody you really should just let your dad die and take in the title out of his estate, because now you're going to pay this ginormous amount of tax on the capital gain, right?
I actually met somebody who did all that except for murdering their dad. And then they made two other big mistakes on top of it. They sold within a year after installing a relative as a resident. And bang, bang, no long-term capital gain rates. And because it's a personal activity, once you put a relative in that house, it becomes a personal activity, not an investing activity. And so they don't even get to deduct the loss that they would otherwise have been able to deduct. And so on 3 dimensions, these people were just out of luck.
Sometimes it's just worth picking up the phone and calling you or another tax professional that can give advice.
Listen next time on The Valley Current.